Rahul Singh, Head of Research with Chartered Securities, joins us live from his Mumbai studio with his take on markets. Rahul, good morning. Thank you for joining us. Rahul, we've come a long way from the recent low. Markets are looking stable, flows are strong, and risk on trade is clearly the flavor of the moment. What is your market take? Do you think worst of the price action is behind us? It's time to be a buyer now because things are no longer on a butcher block.
Yeah, I think on the domestic front, things have stabilized to, mainly I'm talking about the currency. But I think the focus will shift to the fiscal deficit going forward where things are not looking so rosy. So I think we are looking at this period being a shoulder period where things are not too bad, not too good either. So the focus will be on bottom-up results going into the results season in the next month and a half. And therefore, I think we see no reason to have too much optimism from an earnings point of view. So I think the markets will have a downward bias throughout the results season is what I would probably put my assessment right now at. There are obviously bright spots in the earnings for tech sector, pharma, etc. But otherwise, on the broader economy, especially on the consumption side, we might see very weak numbers in this quarter.
Rahul, hi, morning. Could Infi turn out to be that bright spot, or do you think all the positive is already in the price?
Sorry, which one you said? IT services? Oh, Infosys, I think Infosys we are not very optimistic that the turnaround can be very sharp in terms of the management change there. I think those what Infosys requires is a bit of a business model change. So you will see confusing signals coming out of Infi over the next 2 to 3 quarters in terms of the trade-off between growth and margins. Right now, at this point of time, I think the stock is in a fair value zone. So we would actually be advising clients to take money off Infi and deploy them in HCL and TCS and even Tech Mahindra. Because we think there will be the progress of recovery in Infosys, if at all, is going to be jerky and discontinuous rather than one straight line up, which is what the stock seems to be employing. But that's definitely not what we think.
Fair point, Rahul. To stay with us, I just want to mark what the Bank Nifty and the active participants from the futures and options market are. India Cements, and we were talking about the positive sentiment that you may see on the stock price. And clearly, as the Supreme Court has now allowed N. Srinivasan to take charge as the BCCI president, you're seeing some sentimental rub-off in India Cements. It's holding up by about almost 0.5%. PTC, clearly, that's the stock of the day ahead of its earnings. And of course, it's received a 778 crore rupee from UP Power Corporation as well. And PTC is going pretty strong. It's a good 6% move that you're seeing on PTC alone. Reliance Infra as well. There seems to be a whole lot of fund buying that seems to be kicking into this one. Rel Infra, although a little tempered, it's a little soft right now, down by about 0.5% or so right now. But Rahul, just want to get back to the point that you were making. You did mention stocks like Tech Mahindra. What about the other mid-cap IT names, the likes of a Persistent System, eClerx, Mindtree? All of them have been making fresh highs. What is it that you like in the mid-cap IT space, aside of Tech Mahindra, obviously?
We like Mindtree and eClerx. These are the two stocks we cover. We don't cover others. So these are the two names we would recommend. But even among the outside of top 4 and large companies, so we don't have to really go down to mid caps immediately. But yes, if you do want to go there, then these companies are still trading at very, very reasonable valuations, not only relative to the top 4 IT pack, but even relative to the market, and that's just inexplicable as to why they should stay there. So I think there is a case for these stocks to get re-rated as well, closer to the large cap IT PE multiples. Obviously, they will not go to 15-20 times, but at 9-10 times, the gap is just too much for these stocks right now.
How would you approach banking then, Rahul? Both privates as well as the PSU lot, and do you think that this quarter again we are going to see a significant NPA jump?
Well, in this quarter you may not, but if you just step back a little bit, in a scenario where we don't see rates coming down fast enough, and I'm not talking of the short-term rates, I'm talking of the long-term rates and the repo rates, where we see 50 bips hike over the next 3 months. And in a scenario where growth is still not bottomed out, so to say, or if it has bottomed out, it is probably going to stay at this bottom for some period of time. And in a scenario where rupee has depreciated, margins are under pressure, and the significant policy changes in the power and the metals and mining space, which is where bulk of the corporate debt is sitting, the policy changes will probably have to wait after the general elections. I think there is going to be the combination of these three factors means that we need to stay away from the banking sector as much as possible. Obviously, it's a large weightage in the index, so you can't go severely underweight, or you can't have a weightage which is significantly lower than the index weightage, which is 22-23%. So I think the best way to play the banking sector would be to hide in the large retail banks, HDFC Bank, IndusInd to some extent, and have exposure only through ICICI Bank if you're feeling brave enough. So I think in terms of the banking sector, it's fair to say that we are quite negative as things stand today.
Rahul, one core reason why private banks have suffered was after the RBI action, after RBI increased the MSF rates. But they've reversed their MSF rates completely. MSF rates are down by about 125 bips from the July high. How come markets are not recognizing that RBI move? Because the reversal in MSF rate is a big earning booster for banks like Yes Bank, IndusInd Bank, Axis Bank, ICICI Bank.
Yes, it is, and to that extent, it is a bit of a relief, especially for the private sector banks who rely more on wholesale funding. But as I said, the core issues of a slowing economy, high interest rate environment for longer, and the fact that the corporate debt is very concentrated in sectors where the policy changes might be very, very slow, means that some of these banks would remain kind of trading bets. They won't be a straight line, 3-year kind of multi-year returns kind of stories as yet. So we would rather wait for the right timing for getting into these stocks from a long-term perspective. Now, obviously, within this long-term or within this 1 or 2 year kind of flat to downward trend, you will get trading opportunities, significant trading opportunities, those might be. But given where things stand today and the fact that stocks have bounced back from their lows after the RBI kind of announcements and interventions, the risk reward doesn't seem to be that favorable to jump in right now.
Rahul, so let's say in the run-up to the election, which is May 2014, what should be an average return expectation from Indian equities? Do you think Indian equities in the next 6-7 months could give double-digit gains, or that's slightly out of sync?
Yeah, I think that looks very unlikely, to be very frank, because right now, if you look at the market P multiple, we are at about 14.5 times 1 year forward, and that doesn't get justified very easily, given that we've seen earnings growth rate slowing down. We are now forecasting only 10% growth rate for FY14, and FY15 also. I think there is significant risk of earnings cut. On the other hand, the cost of equity is going up for India with the risk-free rate going up to 8.5%, which is the 10-year bond yield. So logically, mathematically, you cannot justify anything higher than where we are standing today. I think the valuations are quite generous, and if at all there is anything, there is a downside risk from the current levels, especially if the QE taper expectations start to get built up again from November, December onwards. So just remember that the fact that we are at a P multiple of 14.5 times, despite having a risk-free rate of 8.5 and earnings growth rate which is in looking like high single digits, is because of the global liquidity environment and the fact that the QE taper. The expectation is that the QE taper might be very moderate, which if it happens, it's good, but there is no such certainty like that, and therefore, a sudden kind of change in the macro global scenario can be pretty negative for our valuations given where they stand today. So I would say the trend would be downward from now till the elections, but within that, you will obviously have trading opportunities given the global scenario.